The U.S. grain markets, particularly corn futures, have been in a downward spiral since the March 29th USDA report. According to the United States Department of Agriculture, the markets are dealing with a massive bumper crop. We've been of the belief that the grain markets would firm up as the U.S. and China work through their trade differences. However, despite widespread acceptance of some sort of imminent deal by the stock market, grain traders refuse to price in the possibility of any kind of progress. In fact, they seem to be waiting until pen hits the paper to actually account for that. With that said, grain traders are definitely justified in their short-term outlook. I mean, don't forget, grains are an annual renewable commodity, so the prices of the current crop year have little to do with next year's fundamentals. We like to keep an eye on the Commitment of Traders report, or the COT report. It's released by the CFTC, the Commodity Futures Trading Commission in the U.S. This report tells us who's long, who's short, and by how much, or how many contracts. The large speculative group, which is assumed to be the smart money, is holding a net short position in corn to the tune of about 155,000 contracts. This is an excessive position. It's more than we've seen in years and maybe even ever, depending on which figures you're looking at. Similarly, when we're looking at grain futures as a whole, corn, wheat, and soybeans, speculators are as aggressively bearish as we've seen them in quite some time. We have to wonder, if everybody's already short, is there going to be any sellers left to take action? From a seasonal standpoint, grains are generally moving higher overall during this time of year as traders begin to build in a risk premium for the upcoming planting and growing season. Of course, this year has been the exact opposite. In fact, we're coming into the planting season in a trough. With prices highly discounted, we have to believe that seasonal pressures, as well as the potential of a Chinese trade deal, as well as market nature, market forces, again, everybody's short. The way to get out of the market is to buy those contracts back, which could put upward pressure on prices. With all that said, we think that corn could see the high 380s again, maybe even up around the $4 area if these shorts that are positioned in the market currently begin to cover their positions and if fundamentals start to stabilize. Let's keep in mind that grain traders are pricing in a nearly perfect planting and growing season, and we rarely make it through the crop cycle without some sort of scare, or maybe two or three. Perhaps the grain markets are the epitome of a value play in commodities.